This is a quick video to introduce you to Monday's topic. We're still in the consolidation area. So what we want to look at is what happens when you have one company controlling another company and they sell assets between each other. Before we look at that, let's just talk about what we would already know. Assume there's a giant corporation that has multiple divisions. Assume two of its divisions are Division 1 and Division 2. Again, these are not separate corporations, they're just subparts of this big corporation. Now assume this Division 1 makes a component that becomes an input to the production process of Division 2. What a lot of companies will do is have the divisions sell to each other. So let's assume Division 1 sells goods to Division 2. When divisions of a single company sell items to each other, you might recall we call that a transfer price. Whatever the selling price is a transfer price. In other classes you can talk about that. That can be very important. But the question we're concerned about here is, would you let very big corporation on its income statement that it shows to the world claim that as a sale? Hopefully you're thinking, no, that was not a sale. That was just one division of the company moving inventory to another division of the company. That's not a legitimate sale. Well, it's going to be the same in the consolidation area, because even though we're going to have two corporations, because one corporation controls the other, we're not going to let any intercompany sales count as real sales when it comes to doing a consolidated income statement. So let's make a simple example. Assume there's a corporation called Big and it buys some inventory. It has a subsidiary that we'll call Small Company. So Big Company goes out and buys inventory for $100. Further, let's assume it sells that inventory to Small Company for a higher price, for say $150. Now notice for Big Company, the inventory that they paid $100 for is now gone, so they're going to treat that as cost of goods sold of $100. All right, let's go back. They bought it for $100, but now from their viewpoint they've sold it to Small, a separate company. So on Big's own financial statements they would say they have sales of $150, cost of goods sold of $100. Small Company has bought this inventory, so on their balance sheet they would claim $150 of inventory. Big corporation would say, we have a profit of $50 on the sale of inventory. Let's assume that the year ends at that point and it's time to do consolidated financial statements. Consolidate Big's financials with Small's. The question is, how much of that profit would you let Big show on a consolidated financial statement? Is that a legitimate sale? How much of the sale of $150 would you let them show on a consolidated income statement? Hopefully you're thinking to yourself, well, these are not two separate companies. When it comes to a consolidated financial, this is just one company. These are two divisions. So I'm not going to let the sale get reported. I'm not going to let the cost of goods sold get reported. I'm not going to let that profit get reported. What I will let get recorded is inventory. But would I report it at $150 or at $100? Has anyone at this company ever really paid anyone outside the company $150 for that inventory? Hopefully you would say no. So let's think about what we want to do. Let's go to the idea of a worksheet. Okay, assume we show up to do the worksheet consolidation. Let's think about what numbers Big and Small would be reporting. For simplicity, let's assume those transactions were the only transactions they had. Well, the Big company is going to claim that they had sales of $150. They're going to tell us that their cost of goods sold was $100, and they're going to say at the end of the year they had no inventory. Small Company is not going to have any sales, any cost of goods sold, but they're going to be claiming that they have $150 of inventory. So let's think over here in the consolidated statement. How do we really want things to look? Well, we're going to say that sale never took place because that was intercompany between two companies that control each other. So that sale didn't happen. So we need that number to end up at 0. Because that sale didn't happen, we're going to say the cost of goods sold didn't happen since no goods were sold. And we want the inventory number to end up not at $150 but at $100 because that was the original cost of the inventory to this consolidated entity. When Big bought the inventory, they paid $100. This company, Big and Small together, have never paid anyone else $150 for that inventory. So now that we know where we're starting, where we want to get to, we can see the types of adjustments we're going to need. So if sales are $150, I'm going to need a debit of $150 to make sales go down to 0. I'm going to need cost of goods sold to go to 0. That's an expense, so that would have a debit balance, so to get rid of it, I'm going to need a credit. And I need to reduce inventory by 50. That's got a debit balance, so to reduce it, I would make a credit. So pause a minute. If you need to, go back through the logic of that, because I'm going to make a slight change. What the authors of your textbook are going to do is break this into 2 separate entries. The first entry, they're going to say, so let's get rid of the sales. So they'll debit sales for 150 and credit cost of goods sold for 150. You might say, that's a problem because that's going to make cost of goods sold go negative. You're right, but they're going to fix that with a separate adjustment. A separate adjustment they're going to say to make is to take care of that profit that Big is reporting, that $50 of profit. We don't want that profit to make it through. So now I'm going to have a separate entry to get rid of that. And the entry for that is to debit cost of goods sold for 50 and then credit the inventory for 50. So now I get to the same place I wanted. I'm just going to make 2 separate entries. Now in the interest of time, even though in reality that would be done on a worksheet, we're not going to do big worksheets again. We just don't want to spend that kind of time. But try to keep in mind the adjustments we're talking about would be done on a worksheet, but the textbook's going to typically show it to you in journal entry format. So what you want to do is commit these to memory. So your authors call the first one TI for transfer of inventory, and that will always be a debit to sales and a credit to cost of goods sold. In this case, it was for 150. The second entry, your authors labeled G for gain. That's to get rid of the gain that Big was reporting. That was a $50 gain. Our adjustment there will always be a debit to cost of goods sold for the gain and a credit to inventory. You want to get to the point very quickly where you have those 2 adjustments memorized, at least the account names, because they're always going to be those accounts in that order. Let me make one more change, and let's see what the effect is. So going back to my original example, Big bought inventory for 100 and then turned around and sold it to Small. Big controls Small, so this is a consolidated group. And Small, in my previous example, just hung on to the inventory. They never did anything with it. And then the year ended. Well, what if Small doesn't just sit on the inventory? What if they sell it to their customers? Let's say they sell it for $300. Well, now Small's going to have some sales to report on its own small company income statement, and its inventory number of 150 would convert into being cost of goods sold for Small. So now both companies on their individual income statements, not consolidated, their separate income statements, are both reporting sales, and they're both reporting cost of goods sold. They're both reporting profits. The question now is on a consolidation, what do we want to do here? How much of the sales are we going to let stay on a consolidated statement? Should sales be 0, 150, 300? What should the cost of goods sold be on a consolidated income statement? How much of the profit should stay on a consolidated statement? The key here is that Small has resold all of the inventory to someone other than Big. They've sold it to an external, unrelated party for $300. So if we look at Big and Small as just being one company, what were sales? Well, sales weren't really 150 because that was Small paying Big. So sales were 300. That's what the controlled entity was able to sell this stuff for to outside customers. What did the inventory really cost the group? It cost them the original $100. So consolidated sales should end up being 300. Consolidated cost of goods sold should end up being 100. Well, that's a difference of 200. And that's what their profits combined show. So the profits are okay now. What we really need to fix is the sales. We can't combine Big and Small sales now, and we can't just combine their cost of goods sold. So on a worksheet, Big, when we get there, would say their sales are 150, their cost of goods sold is 100, and that they would have no inventory. Small now says on their income statement that they had sales of 300, they had cost of goods sold of 150, and they have no inventory remaining. How do we want things to look? We want consolidated sales to be 300 because that was the amount of the sales that went to external parties. What did the goods cost this controlled group? For that number, we want it to end up being the 100 because that's what the control group paid for that inventory that they later sold for 100. And we don't have to make any adjustments to inventory. So if small resold all of the inventory, the only adjustment we need is the first one, the TI. We have to get rid of big sales. We've got to get rid of that, and we have to get rid of small's cost of goods sold number. And that TI entry does that for us. Again, this would be done on a worksheet, but for purposes of our problems on the test, problems in class, we're going to write things in journal entry format. The last remaining question that we'll save for class is what happens if small sells some of the inventory, but not all of the inventory? The cases I gave in this video are small didn't resell any inventory, and then secondly I showed what if small sells all of it. In class, we're going to look at what happens if small sells some of the inventory, not all of it. See you Monday.